The February series was one of the most volatile series since April 2021 expiry, NSE data shows, with the average daily swing for the NSE Nifty 50 index as high as 1.4%, average difference between the day's high and low. Such levels were seen back in April 2021 series when the average daily swing rose to 1.55%, and earlier in the March 2021 F&O series when the swing was as high as 1.77%. The mean average for the last 12 months F&O expiry has been 1.19%, with July 2021 series as the least volatile with a daily average swing of 0.77%. The Nifty 50 index has slipped over 4% in February F&O series to 16,200 levels. So what does this mean, and how should you approach the March F&O series that begins today? Analysts expect the March series to be choppy as well, given the multiple headwinds that the markets face. At the fundamental level, foreign portfolio investors remain extremely uncomfortable with India's valuation premium, analysts have said, and have sold nearly $11 billion worth of stocks over the past 6 months. In the next few weeks, the India equity market may remain choppy and offer good entry opportunities on large corrections, Credit Suisse Wealth Management suggests investors focus on domestic cyclical companies such as banks, cement and staffing companies, apart from reopening trades including multiplexes. The major risk can come from oil shock for Indian equities as reopening of the global economy may spur demand, Credit Suisse Wealth Management. The markets will keep a close tab on the ongoing tussle between Russia and Ukraine. Analysts point at keeping a close eye on the consequential sanctions impacting businesses with Russia and any spillover of the impact on the neighboring European countries. On the positive side, a peace deal could send stocks soaring across the globe. Equity markets always react in a magnified manner to the initial events and finally adjust to the fundamental consequences of the event. Global equities, including the Indian markets, may fall another 2 to 3% from the current levels and would start adjusting for the perceived eventual consequences thereafter. G. Chokalingam, founder and CIO, Economics Research. After a few weeks, the war either would stop or continue as a proxy war for a longer duration. The global equities would adjust for these eventual consequences within 2 or 3 weeks. G. Chokalingam, founder and CIO, Economics Research. As a fallout of the geopolitical situation, rising crude oil prices are proving to be another sore point for global equity markets, especially India, that imports around 80% of its crude oil requirement. Brent crude broke above the $100 mark in trade on Thursday after Russia ordered troops to invade eastern Ukraine. With global economies battling inflation, soaring oil prices can further fuel inflation and in turn disturb the fiscal math. If the prices remain elevated for long, it will have an impact on corporate earnings growth across some sectors as well over the next few quarters. Another global development to keep an eye out for is US Federal Reserve meeting on March 15th and 16th. According to experts, the markets so far seem to have factored in a 25 basis point rate hike by the US Fed, and any disparity in expectations could result in a knee-jerk reaction for the markets. At the domestic level, the outcome of the ongoing assembly polls across 5 states, including Uttar Pradesh, Punjab to be announced on March 10, will be keenly watched. Although there may not be a direct correlation between the elections and markets, any favorable verdict for BJP in non-ruling states such as Punjab and Manipur could boost the sentiment. Lastly, financial year-end portfolio rebalancing by DIIs and retail investors who have mostly been net buyers across fiscal 2021-22 may want to book profits towards the financial year end. Let us now go to Gaurang Shah, Senior Vice President at Geojit Financial Services, to understand how investors should navigate through this uncertain phase for the markets.
These are the levels, Puneet, we had touched a couple of times. December 20th, 2021, we made a low of 16,600. Before that, August and September 2021, we were at 50s, same levels, 16,500, 16,400. So barring the short-term, medium-term, concerns, I think earnings, if you go by, and the outlook, these are great times for long-term investors to get into the market. There could be choppiness, volatility, depending upon what the news flow is, but I don't think the markets keep on reacting to the same news flow again and again. Sectors like, paint companies, FMCG companies, tire manufacturing companies, aviation companies, FMCG companies to a certain extent. Wherever you have some crude playing its role in the input cost, there you might see a little bit of downtick on the earnings front. But it depends how much of oil we import from Russia, oil and gas, and how much we import from the other part of the world. The price hike on petrol and diesel remains to be seen when the government decides to hike. But in terms of percentage, I don't think there's going to be a serious impact on the earnings front.
On Friday, the markets will continue to keep a tab on the developing geopolitical situation and its impact across key asset classes. Stock-specific movement based on news flow is also likely.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.